start with inflation here. A lot of economists are worried that inflation is looming right around the corner, but it seems that President Biden and the Fed chair feel that the risk of overheating the economy is much lower than the risk of failing to heat it up enough. How do you see it, Ronnie?
Well, actually, if we look at markets, I mean, they're screaming inflation. If you have a look at monetary aggregates, if you have a look at debt numbers, I think, one of the big differences compared to 2008, 2009 versus now is that back then we had unprecedented monetary stimulus. But now we are seeing unprecedented monetary stimulus all over the globe and extreme numbers of fiscal stimulus. Additionally to that, we're seeing average inflation targeting. So actually the Federal Reserve says we can let inflation numbers overshoot. So at 2%, we can say, okay, well, inflation was undershooting over the last couple of years. Now it can overshoot to 3, 4, 5% without having to think about raising rates. And then, of course, we're seeing, stuff like MMT, like helicopter money, universal basic income, those topics, those theories where I would say, like the wet dreams of left-leaning economists, but now they are really becoming mainstream. They're really becoming center stage. So I think there's lots of ingredients for inflation to continue to rise. And as I've said, just have a look at, equity markets. The Bloomberg World Exchange market cap is now at 110 trillion, which is 25% higher than before the pandemic. Are public companies really 25% better off than before COVID? I doubt it. Have a look at Bitcoin at 50,000. From my point of view, this is really what Ludwig von Mises, an Austrian economist, described as the crack-up boom, or in German it would be called the Katastrophenhoch. So it seems that people are really losing confidence in paper money. They want to go into real assets. And from my point of view, that's a very dangerous market environment that we're seeing. As you can see on the bond market, at the moment, yields are at 1.3%. That doesn't sound like a lot. But, in August, when gold hit its all-time high, yields were at 0.5%. So it was a pretty big move. And from my point of view, as we have to refinance 8.1 trillion of debt in the US this year, as we all know that the economy cannot really afford higher rates. From my point of view, yield curve control will be implemented pretty soon. And that should actually show us the next leg down in the US dollar, and probably will also be the catalyst for the next move up in gold.
When you say we can't afford higher rates because you feel that the consumers need to be spending to keep this economy going, why do you say you fear it?
Well, actually, we wrote a book. It was called The Zero Rate Trap, where we basically described that it is basically impossible for our system, for our economies that are really so addicted to low yields and cheap liquidity. It is basically impossible to see a sustained move to significantly higher real interest rates. So therefore, I think, everybody, not talking, but just thinking about a rate hike by the United States, I think doesn't really remember the 2013 taper tantrum that Ben Bernanke faced. And, if we should have like a second taper tantrum, this will make 2013 look like a kindergarten party. So I think that if you look at the communication, the wording coming out from the Federal Reserve, I think they have indeed made a 180-degree shift, because now Jay Powell, for example, last week, he said that official unemployment numbers, they don't really capture the labor market slack. So from his point of view, unemployment is significantly higher. The Federal Reserve is telling us, well, okay, we will hike rates, but only when we see full employment. And therefore, I think this overshoot in inflation numbers, it is not something that, it is not a tail risk. It is actually our base case. And let's face it, every central banker on the world is quite vocal. They are telling us we want more inflation. Inflation numbers are too low, and at some point they will get what they want.
And Ronnie, when you say we're seeing this movement away from fiat currencies into assets, into hard assets like Bitcoin and gold and silver, we're seeing that momentum in Bitcoin, but where is it for gold?
Well, that's a good question. I mean, I think in August last year, gold was really big topic but I think, just from anecdotal evidence, newspapers, magazines, everybody was writing about gold. Now it seems like the most boring topic. But boring is sometimes good, and I think it's prudent to buy an insurance when it's cheap and not when the house is already on fire. So what we're seeing over here in Europe, for example, is that more and more institutional investors are adding gold, strategic gold positions to their portfolios, because they all know that the negative real rate environment will continue for the next couple of years. We saw last year, for example, we saw enormous inflows into gold ETFs. Only in the fourth quarter, it was down just a bit. We are seeing demand from Asia being very, very strong. I mean, let's face it, 1989, China and India were responsible for 10% of physical demand. Last year, it was 56%. So from my point of view, gold is kind of, I don't want to say at a sweet spot, but yesterday, for example, we bought more gold stocks for our fund because it's clearly unloved.
And like you said, maybe there's just a lot of background conversations happening behind the scenes, not visible to the public. But what I like about you, Ronnie, is you are the author of In Gold We Trust, but you also have embraced Bitcoin, right? And I've talked about this in past episodes. We've had people, Bitcoin versus gold, but you've embraced both. You've said they are both not inflatable, and you make the case that Bitcoin and gold are actually stronger together.
Daniela, you know that gold is a very emotional topic.
Yes.
And everybody thinks
much.
He has to have an opinion on gold. And, it's either extremely positive or extremely negative, but there's nothing in between. And I think with Bitcoin, it's pretty similar. And, I bought my first Bitcoins in 2012. I sold them, most of them, too early. And my wife always tells me, why didn't you buy more? But for us at Incrementum, it has just been interesting topic and development to follow, because I think what's really different now compared to 2017 is that institutional demand is picking up. So back then it was more like a wild college party, but now it is really something. I think Bitcoin has kind of grown up, and I hate the fact that it's always Bitcoin against gold. Should I buy Bitcoin or gold? I think, it's two different asset classes, currencies, whatever. From my point of view, you can get from point A to point B in a large Volvo SUV, or you can a motorcycle, a Ducati Panigale, for example, which, with the enormous acceleration. But I think, that the way we played, we use the volatility of Bitcoin. We love volatility. For some reason, they always tell us volatility is something bad. We use the option market to harvest the volatility of Bitcoin. And we think, both currencies, of course, gold has a track record that is 5,000 years long, but also Bitcoin has a pretty decent track record. I think both fit pretty well into a portfolio: gold for stability and Bitcoin for convexity.
You're labeling Bitcoin a currency, which is a debate in itself. So currency or store of value, or both?
Well, I think, perhaps I wasn't precise in my wording. I think it's nonsense if people say, it's just too volatile. You won't buy your coffee at Starbucks with Bitcoin.
Right.
Perhaps true, but you won't do the same with gold. From my point of view, both assets based on their stock to flow ratios have a natural inflation rate of 1.6% at the moment. For Bitcoin, it halves every 4 years. So in 2024, it will be half the inflation rate of gold, actually. And just this stability and the trust that you can put into the future supply, I think, is something really special in a world where we are seeing such aggressive inflationism by central banks. So I think those are really topics that we enjoy. We can talk about the technical details at length, but I think it makes sense, and this is at least how we play, to rebalance every now and then. We've got no clue where the price of Bitcoin will be in a couple of years. It will probably be quite binary. It will either be at a couple of 100,000 or 1,000,000 or at zero. But I think it makes sense to combine those two assets, those two
Have a mix of both. But I guess just getting back to the currency, why many people don't see it as a currency is because the price keeps going higher. No one wants to let go of it. No one would want to spend their Bitcoin.
Of course, and I think now we are seeing it is a bit of a Soros would call it a reflexivity move. It is rising, the price is going up because the price is going up. And I think this is something, what I enjoyed at the very beginning of this movement was those were young people, very technically skilled people that were about to challenge our monetary system, and they were questioning, what is money? Why is gold money? Why could Bitcoin be better money than gold? But now it is really, I think speculation and it is just only how high can it go? How can I take the most leverage? What other altcoins should I buy? So I think this understanding of our monetary system and some sort of a hedge against our fiat money system, this is something that is a bit lost at the moment.
Ronnie, let's bring it home here. So we started off talking about inflation, major inflation concerns. What I'm hearing from this conversation, for you, the safe havens right now, Bitcoin, gold, you've invested in mining stocks, any other sectors that you're looking at?
Well, we like the commodity space in general. Our inflation signal that is basically telling us when to play offense and when to play defense is suggesting, okay, we can take more exposure, more risk also in the smaller cap names. But I think, it seems that right at the moment, the market is really getting a bit nervous about the rise in yields. So I would really have a very close look at the bond market and also at the US dollar. I think that the dollar is due for a bigger bounce. But if we should see yield curve control being implemented, I think we will go significantly lower. And then actually, everything is going to be if you get the dollar right, you will basically you shouldn't have any troubles making decent performance. And I think, as I've said, yield curve control will be implemented probably pretty soon, and this should really be one of the main triggers to look
But
for.
with rising yields and yield curve control, you still see a case for gold going higher this year?
Yes, absolutely, because that's gonna mean negative real rates basically forever. And if there's just one number follow when it comes to gold, it is probably the absolute level, but more importantly, the direction of real interest rates. So from my point of view, as I've said, we just cannot afford significantly higher real rates. Those days of 5 or 6% positive real rates, those days are over. So from my point of view, that should really be the main understanding when it comes to gold. If you compare it to the last all-time high in 2011, just look at what happened. The balance sheet is up 4 trillion. We're seeing national debt during that time has basically doubled. We're seeing 18 trillion in bonds trading at negative yields. So therefore, I think once we go through this, it's kind of a giant cup, and if we break through this through this formation, probably the next stop is at somewhere at around 3,000.
So when you say dirt cheap, sorry, Ronnie, but we are close to that all-time high. I mean, we're not, we're still like $200 away from 2,000. But you're saying it's dirt cheap, but look how long it took us, look how long it took gold to get to $2,000.
Yeah, but we shouldn't forget, I mean, that gold rose from $200 to 1,900 in basically 1 decade. So that was a really big move to digest. And therefore, I think, last year was really the first year when institutional players were getting interested again. And let's face it, gold made all-time highs in basically every currency last year, also in the US dollar. And from a technical point of view, from a more longer-term view, I think it's a nice setup. Sentiment is becoming really negative now. Positioning has improved. Nobody really cares about gold anymore, so I like it here.
Last point, I swear. You mentioned that you're buying some more mining stocks. Could you give us any insights? You mentioned small caps, so what are you liking in the mining sector? Is it the explorers, mid tiers, the barracks? Who do you like?
I think, if you have a look at the mining space, I think it is showing relative strength, quite similarly to silver. I mean, normally if a big bear market of gold should be about, then mining stocks should correct much more, and silver should massively underperform gold. So this is a sign for me that actually that's only a smaller correction within a long-term bull market. So what we are buying is really junior developers. We are buying also lots of companies in the silver space. From our point of view, I have never seen a bull market in gold with silver underperforming. So I think, let's forget about this whole silver squeeze recently, but I think, we will go this year clearly above $30, and I know many companies that will produce a tremendous amount of cash flow in the silver space. In general, I have to say, when I did like 150 company meetings last year, and it seems that the mining space has never been healthier than at the moment. I'm seeing pristine balance sheets. I'm seeing record amount of free cash flow produced. I really like the mining space at the moment.